In this video, we're going to talk about the Hyliion, trading under the ticker symbol HYLN. Right now, there's a lot of volatilities coming out of the financial market and especially amongst the growth stocks. We have to be careful about which stocks to purchase and the exposure of timing of those trades. This video is going to cover the recent price actions and the technical aspects of the stock. Before the video begins, a quick heads up that my analysis is based on sessions already completed and that it may not take into consideration the latest events. If that is the case, I'm going to make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock increased to $3.90 before closing the trading day at around $3.80. We should pay attention to the $3.76 level nearby because it was tested multiple times over a relatively short period of time, which makes it a significant level to watch out for. Over the past 30 days, the trend of the stock has been ranging between $4 and $4.50. Hyliion has been going through a very long phase of bearish grind over the past 6 months or so, and even if we have yet to see a clear sign for reversal, or even just a very clear sign of support, the stock itself is showing some glimpse of support, and we should definitely start thinking about whether now is a good entry point. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock has been bearish, even if the real answer is more like, well, you see, the stock has been on the good and the bad end and the very bad end of volatility over its existence, and pretty much reacted as predicted to what the financial market wants to get from the EV market. It was initially a place to park your money into until the economy identified other locations to do this, to assume this role. And then the stock is at the mercy of market mood swings. When we look at the price trend overall, it's been slowing down, because the stock is now low enough so that those who want to sell already did so, and those who want to short the stock probably already recovered their positions. At the moment, it's just under the effect of the market's lack of demand for EV stocks in general, which explains the slowing but ever grinding downward pressure. The trading volume of Hyliion has recently been 2.4 million shares versus the average volume of 2.5 million shares. During the previous 52-week period, its price fluctuated between $3.33 and $14.80. The market cap of Hyliion is currently at $654 million versus the enterprise value of $706 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst market participants, the assets value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statement, so it's less reactive than the market cap and often more lenient for many companies. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is called goodwill. Goodwill is the expectation of the market that this company is able to do better than its rivals. It can grow faster and yield more profits because it's assumed that it may have, for example, better management, stronger brand recognition, bigger online following, and so on. It is what makes a company unique compared to its competitors. In other words, it's not a tangible asset to generate income, but it's often the reason why some companies are perceived to be trading at a discount compared to the market cap, because the market cap doesn't include this big chunk of imagination or speculation or hope called goodwill. But if a company goes to liquidation, the goodwill is no longer, and we will have to make do with whatever that is left that hasn't depreciated yet on the balance sheet. When we compare the current price to its historical price fluctuations, the stock is 13% higher than the 1-month low, 13% higher than the 3-month low, and 13% higher than the 52-week low. On the options market, which gives hint on the market sentiment about where the stock price may head towards, the implied volatility is 92% versus a historical volatility of 87%. The put-call volume ratio is currently at 0.32. It's normal for most stocks to tend to have a higher put option volume than what they deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 1.8 thousand contracts, versus the 30-day average volume of 1.8 thousand contracts as well. For open interest, the most recent volume of open interest is 38,000 contracts, versus the 30-day average of 36,000 contracts. Regarding the shareholder structure, institutional owners have about 30% of the company. The biggest shareholders include Vanguard, BlackRock, and State Street. It's relevant to understand the shareholder composition of a company because it helps to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, it can be a sign that the stock lacks the depth to justify long-term trust from shareholders. The consensus is that there should be about 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Now, of course, there's a lot of exceptions for this, since many great companies are also held by retail traders for the most part, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes there is significant short interest in the total volume, and this can be a sign that there's an organized shorting operation going on. The current short interest is 16% of the total float, and 42% of the transactions are coming out of the dark pools. So overall, my opinion on Hyliion is either to start building a position now and average down from there, or to look for a lower entry point later. The maximum exposure I would recommend is 1 to 3% of your portfolio. For the immediate term, my recommendation is to buy the stock, considering the recent price actions and the promising price levels that are close to where the stock is right now. I would recommend to separate the allocation in batches of 20% at a time so that you have enough room for later purchases. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world, and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.